Stress-free property investment. So my first tip is to have 2 months worth of expenses in the bank in an offset account, so it's coming off your mortgage, so you're not paying interest on it, and that enables you to cope with a vacancy or some unexpected maintenance, or just really takes the stress off if a tenant happens to be a couple of days late with the rent. There's no bank fines for a missed payment. My second tip is landlord's insurance. I find it's probably the best value money an owner, property investor can spend on a property. From between $200 to $400 a year can be protected from any damage to the tenant, lost rent, and a myriad of other things that general insurance doesn't cover. So I think that's probably my second biggest tip for a stress-free property investment. Principal and interest loans. I'm of the firm belief if you can't afford to pay the principal down, you probably can't afford an investment property. That's where you're exposed. If the market doesn't go up for a couple of years, you could end up in a negative position should you need to sell the house. So my view is always finance it around principal and interest over 25 years if at all possible. Proactive maintenance. This is one of my biggest recommendations for all owners. We tend to buy an investment property and resent spending any money on it. I think $40 a week can make an enormous impact to the capital value of your property, attracts better quality tenants, and also gets you higher rent. So think of budgeting for $40 a week to go into proactive maintenance for your investment property. I think choosing an investment property is one big decision. I think the second big decision in buying an investment property is having the right property manager. Often people either try and do it themselves, and it's a very difficult thing the way the legislation is now written. There's no buffer between you and the tenant. And the other area where I see people coming unstuck is they go for a cheap rate. Those guys, because of the fee they charge, basically can only collect the rent, and there's a lot more to property management than just collecting the rent. Yeah, I recommend all owners not to go for the maximum rent. Always set it about 95%, and there's a very valuable reason for that. Firstly, it'll always be rented. Secondly, you get a bigger pool of tenants to look at, and you can choose a better tenant. And 3, they're less likely to leave you if the market downturns a little bit. The next area that's ended up in disaster for a lot of people is renting to the family or friends. It's a separate transaction. This is part of your business world. Don't bring your family and friends into your business world, and don't rent to family and friends. That's another area that we've actually had to rescue people. And I can tell you, over the years, most of our rental arrears have been from family members of property investors. Yeah, the next tip is don't have a relationship with your tenant. Stay away. Your agent is your shock absorber to keep the tenant's silly requests away, and it just builds on the emotion. So stay away from the property if at all possible. Certainly inspect it every year with your property manager, but don't have a relationship with the tenant if at all possible. The next tip is approve property maintenance as soon as possible. Even if it's routine maintenance and not urgent, it doesn't go away, and the longer you leave it, the more expensive it becomes, and if you delay too long, all you do is expose yourself to potential legal action from the tenant, and it can make that whole relationship toxic. So when your property manager rings you with a maintenance request, the quickest, easiest and most cost-effective way to manage that is to do it straight away. There's the next step to look at doing. The next tip is a professional depreciation schedule. It costs between $250 and $300 depending on the property. There's a lot of legitimate tax deductions for depreciation on properties, and the professional people know where to look for, and their protection should the tax office look at you. So we did a property the other day, was worth about $450, and there was $12,000 a year in depreciation in the first year for that property investor. So that turned that property into cash flow positive after tax straight away. Yes, the final tip is once your equity is about 40% in your first investment property, you probably have enough scope to go and buy your next investment property. So at the end of the journey, if you can buy a new property every 3 to 4 years as the market grows up, you can develop your own nice little portfolio. We have a couple of people that earn less than 100,000 that we look after, and they have over 10 properties. So you don't have to be a millionaire to develop a property portfolio, but you do have to use the equity you've already created in the home that you own.